We started the program talking about inflation fighting being the number one priority of the government and the Reserve Bank. But as we've told you before, New Zealand identified the risk much sooner than Australia, and its Reserve Bank acted rapidly upon it and keeps on acting. But in the process, it seems it may have also tanked its housing market. New Zealand correspondent Jessica Maggio looks at the consequences.
A test of financial resilience.
While our financial system as a whole is resilient, some households and businesses will be challenged by the rising interest rate environment.
As central banks tighten monetary policies and global interest rates rise, New Zealand is under increasing pressure. Reserve Bank of New Zealand Governor Adrian Orr says despite this, the country's financial system is well placed.
We are in a strong position to weather this international challenge.
Economist Brad Olsen agrees, acknowledging all major New Zealand banks have passed annual stress tests.
New Zealand banks have high levels of capital buffers available to them, higher in fact than what the Australian banks have available, which means that when challenges hit the New Zealand economy, the banks have more room to manoeuvre.
In the face of this, we believe that New Zealand benefits from a strong starting point of high levels of employment and a sound fiscal position.
Unemployment in New Zealand sits at 3.3% for the September quarter. A record high of 2.85 million people are in work. For 15 to 64-year-olds, New Zealand's employment rate is the third highest in the OECD at 80%.
What we've known over previous times is that New Zealand households, by being in employment, with having very high levels of employment, people have been earning, they have been able to service their mortgage, they're able to pay their way.
But that won't mean New Zealand is immune to downside risks.
We're telling Kiwis to think and look ahead, that we are currently in good times. We have a strong economy at the moment, but there are clouds brewing.
The Reserve Bank of New Zealand's six-monthly report revealed house prices suffered their first annual decline in 11 years.
We've seen quite a considerable shift in the New Zealand housing market in 2022.
Prices have fallen more than 11% from the November 2021 peak. Auckland saw a 15% drop, Wellington 18%. House sales also down to levels not seen since the aftermath of the global financial crisis. Around 2% of mortgage lending was in negative equity as of September.
Partly that's just because house prices have only really fallen back to the level that they were at in May last year. So that they're still high relative to where they were pre-pandemic.
The RBNZ believes that puts households ahead for now.
House prices falling don't create a financial crisis in themselves. It just means that you're still living in the home.
If more households are paying much more to their mortgage repayments, and some are worried about the price that their house might fetch, they're not going to be spending quite as much in the economy.
The message for Kiwis: limit spending.
We're currently trying to do too much with too little.
Economists predict the official cash rate will rise higher than expected in November by 75 basis points, plus further increases into 2023. The official cash rate peak forecast to reach 5.25%. The Reserve Bank of New Zealand is standing firm, refusing to relent to bring interest rates down.
Actually, the actions that we're taking on monetary policy and financial stability have been well aligned.
Households have been able to pay their mortgages until now, given how high interest rates are rising. Economists say as they continue to rise further, people will be unable to afford their mortgages and houses will be worth less than what homeowners originally paid for them.
And there will be some big challenges over just how much negative equity and how many people are unable to make their repayments as we head into 2023.
Financial institutions are being advised to continue to invest in risk management to build long-term resilience.
We've got to be very careful when we grant new loans. They will have to be tested at even higher test interest rates to make sure that they can not only make their repayments now, but also in the future as interest rates head higher.
Stick close to your banks, and banks stick close to your customers.